welcome to another episode of Banking Matters. I'm your host today, Elizabeth Holtrop, and it is my pleasure to be joined by Kyle Owens. Kyle works as a partner at the Bradley National Law Firm, and today he is going to join us to talk about some issues from his past and current work. Kyle Owens helps clients in the financial services industry navigate risk and solve problems. Kyle represents banks, lenders, loan servicers, and securities firms in a wide range of matters, including regulatory compliance guidance, product development, and litigation and arbitration of consumer and commercial disputes. Kyle has deep experience with federal banking and lending laws and regulations, including bankers, you're going to be familiar with some of these: the Truth in Lending Act, Reg Z, the Real Estate Settlement Procedures Act, the Equal Credit Opportunity Act, Reg B, and various state equivalents. He also provides guidance regarding state licensing requirements. Prior to joining Bradley, Kyle was the primary business counsel for multiple lines of business at a top 10 U.S. bank. Kyle, welcome. I'm so happy to have you on the podcast.
Thanks for having me, Elizabeth. I'm excited to be here.
I am excited to talk a little bit about the legal work you do surrounding banking. I thought perhaps we could talk specifically about reputation risk. I know that's something that you're able to dive into a little bit. But first, I wondered if you could just share with us how you got into working with banking in the intersection between banking and law.
Yeah. Thanks. I was a financial services litigator for 12 years. Okay. And I litigated. I did no regulatory compliance unless there's like a statutory claim involved. And then I had an opportunity to go in-house. So I went in-house to top 10 U.S. bank, to Capital One.
Okay.
I'm in the Dallas office. So here in Plano, they've got a campus where their auto finance business and their mortgage business at the time resided. And so that's sort of where I got my MBA in banking and lending, regulatory compliance.
Got to do a deep dive into that.
Yeah. So I did no litigation. I was straight business counsel for that and really enjoyed it, but found I missed private practice. And so I decided after a couple of years there to go back to private practice. And I've been doing that ever since. So for the past 8 years or so, I've focused on banking and lending clients. I still do about 20% litigation, but what I primarily do and what I really enjoy doing is helping banks and lenders understand the regulations, understand if they breached the regulations, figure out how to fix it if they did, and do some new product development. So it's a lot of fun. We've got a large banking and financial services group, including colleagues here in Dallas, and really enjoy working with the community banks in particular.
I love hearing that you especially enjoy working with community banks and that deep regulatory knowledge, because as a compliance professional, so often we have to make that judgment call where we will tell someone we're working with that you really need to check with legal counsel. And as a compliance professional, of course, we're not going to try to pawn off a question. We'll do the best we can, but sometimes it just has to be a legal perspective as to something. And I love it when we can know that a bank is going to a legal professional who really knows the regulatory side of things and can help with the legal intersection with that. Is that fair to say kind of that's how you bridge the gap for banks?
Yeah. I think that's a good way to put it, is sometimes you need an interpretation.
Yep. I wonder if you could talk a little bit about the main concerns you see banks facing when it comes to current regulations, and especially if you're able to talk about reputation risk right now. I know we talked a little bit that might be an angle we could talk through. I'm hearing a lot of bankers talking about reputation risk right now, and I would love to hear your take on some of those hot spots there.
Sure. So there's been a lot of developments this year in that area.
Yes.
And to summarize, the prudential regulators have jettisoned reputational risk as a factor in their supervision of banks, which is a sea change from the prior practice, from previous administrations. And it's leaving some banks kind of scratching their heads on what's okay to do, what's not okay to do. Can they consider it? Can they not? It has advisors like me and you wondering to what extent we can pull that lever or reference reputational risk, advise about it, encourage it to be considered where appropriate. And so there's a lot of activity related to that. And then closely connected to that is debanking.
Yes.
That's
Yep.
sort of the other side of the coin. A lot of activity about that lately, and I know we'll get to that. But um, I'll go back and kind of give a brief description of sort of how we got to this with reputational risk.
Mm-hmm.
So, and I'll define it first. Let me do that.
That would be
I don't want to
fabulous, just
assume
in case we
folks
have
know.
some folks who are scratching their heads.
Yeah, so it's basically the potential for negative public opinion about your bank that could affect its financial condition, could lead to loss of community support, could lead to a loss of business, and that could be new business or existing business.
Yep.
And the prudential regulators traditionally had included that as part of their examination and supervision process. And so they would look at things like relationships. Could be customer relationships, which we'll talk about in a minute when we get to debanking. Could be with vendors or other partners. Could be with products and services that are offered. It could be related to how a particular account or loan is serviced. And then they also reference social media activity.
Yeah.
So I don't know why a bank would want to do anything controversial related to social media. That seems like an obvious one, but they do warn about it. There was a number of releases in the Federal Register or other more informal guidance where reputational risk is referenced. And so that's where we were. It was something people were very knowledgeable about carrying for and considering in their management. The regulators certainly thought about it, but it became a volatile, controversial topic. There's a deep distrust among the conservative community about how this concept is used by the regulators. And
it had become a political question.
Absolutely.
In many people's
minds.
Yep.
Very much so. And so you may have heard about Operation Chokepoint.
Yes.
But that was an initiative in the Biden administration where the banking regulators and the Department of Justice sort of teamed up to disfavor certain industries. And there's probably 2 or 3 dozen industries, things like gambling or firearms. It could be coin dealers or marijuana related businesses where there was a strong disapproval, I would say, by the regulators, where it wasn't like it was an absolute prohibition, but the message was, if you bank with these industries, you're going to be subject to further scrutiny.
And would you say some of that was related to the concept that some of those industries were already potentially high-risk industries for other reasons, like BSA concerns? Or would you say that Operation Chokepoint was a broader scope than just risk BSA concerns?
Well,
and you don't have to give your opinion if you're not comfortable on that.
Yeah. So I think a lot of it had a legitimate AML connection to it, if you look at the list of industries. But that only goes so far. So, and that would probably be what someone defending that approach would reference.
Sure. Yep.
I think there was the Majority Committee in the House Financial Services Committee. They did reports and investigations about it and said this is an abuse of reputational risk.
Yep.
And it's sort of like UDAP, right, where it's subjective.
Yes.
Right, and you sort of have this concern that, well, maybe someone who is aggressive as a regulator is going to apply this amorphous concept in a negative way. And so I think that's part of it.
When it comes to risk or banking or any of those things, it's much nicer when it's objective or black and white. It's easier to deal with.
Absolutely. Otherwise, you're sort of dealing with self-censorship in a way. And so there is this threat of scrutiny that was in the Obama administration. And then in the first Trump administration, they didn't get to it till the last days of the administration, but the OCC proposed a rule in January 21 where it basically said, if you deny products and services, you have to have an objective reason for doing it. And it's got to be some sort of impartial, objective, risk-based standard that you're applying. That never went into effect because, as a lot of administrations do, when the Biden administration was sworn in, they put a hold on all
Yep.
pending regulations.
Yep.
And so that got us to what we call Operation Chokepoint 2.0,
Yep.
which was very crypto digital asset
Mm-hmm.
based. And again, we have House Republicans
Mm-hmm.
unhappy, producing reports saying this is an abuse of a
Mm-hmm.
legitimate, lawful business
Mm-hmm.
that is not allowed access to the banking system, which
Yep.
is obviously a huge
Yep.
problem for any business.
So that's how we get from reputation risk to debanking as kind of a bridge of a concept.
Exactly. And at the same time as that, we're starting to see some stories gaining traction in conservative media
Mm-hmm.
where there's a really prominent one out of Tennessee. It was a religious-based charity in Tennessee.
Mm-hmm.
They banked with one of the mega banks,
Mm-hmm.
and they got a message that we have to close. We're closing your accounts.
Okay.
And so the head of the charity is a minister in Tennessee.
Mm-hmm.
He didn't. He thought he was being discriminated against. Didn't credit the explanation he was getting from the bank.
Mm-hmm. Mm-hmm.
The bank would say, "Well, you were operating a small business abroad.
Mm-hmm.
We don't bank small businesses abroad.
Yep.
And you were doing debt collection activity.
Okay.
we don't do that either." And speaking of that, that's sort of one of the choke point 2.0
Mm-hmm.
or choke point 1 industries. So the story from this charity was very different. They felt that wasn't legitimate,
Mm-hmm.
and they got a lot of traction in conservative media.
Yeah.
And I would say it was probably a direct result resulted in some of these initiatives in 2025 once the second Trump administration came into office.
Yeah. Okay. So now here we are.
Yeah. So here we are. So in March, the OCC issued a notice saying we're going to remove any reference to reputational risk from our examination procedures and our supervisory guidance. And
They
examiners
went
are
through the
no
guides
longer.
and they put strike through literally through the words reputation risk. Some of
Yeah,
us downloaded the current version, and it's literally just that it's struck through.
Yeah, it was pretty funny to me when I saw the PDFs, but they literally, I think, had some intern go through everything and do a control F to find
It
the
did
word
look like a fine
reputation,
function, didn't it?
and then they just struck through it. So they don't, I don't know. That's one approach. So they didn't do a new document. They just took it all out. And so the Fed in June said, we want in on this.
Yeah.
We're no longer going to make it a component of our examination programs either.
Yeah.
And we're going to remove those references ourselves. They said instead we're going to focus on financial risk, focus on the safety and soundness, which makes sense.
Yeah. And that's the bedrock of risk. I mean, bankers will completely understand safety and soundness as an emphasis. Yep.
Yeah. And I will say, it's camels. It's not caramels. There's no R in there.
Yeah.
Right. And if you think about it, all these other risks you're supposed to be managing for as a banker cover the kind of things that reputational risk would be directed to. And so the FDIC acting chairperson, he issued a statement in June that said, I agree with what the OCC and what the Fed are doing. This really adds no value as its own independent factor to safety and soundness, scrutiny and management. And so we're not going to do it either. We're not going to look at reputational risk. And so I think it was over the summer, Senator Tim Scott in South Carolina passed a bill basically codifying what the agencies are currently going to do to say they no longer can use reputational risk as a component of their supervision.
Okay.
All right. And so then that takes us to August.
This timeline is,
Yes, there's a lot going on in recent months. So in August, President Trump issues an executive order, has some findings. It says the banks have denied financial services based on political beliefs, religious beliefs, or lawful business activities.
The lawful
and going forward
was key. Lawful.
Yeah. So going forward, It's going to be the policy of the United States that no one should be denied
Mm-hmm.
access to financial services on any of those bases.
Mm-hmm.
And so then he's instructed the prudential regulators to do a few things.
Mm-hmm.
The first is to eliminate, which they've already been doing, but eliminate any references
Mm-hmm.
to reputational risk or similar concepts that could lead to debanking.
Yep.
And then they are supposed to review their regulations
Yeah.
and either eliminate or amend any regulations
Mm-hmm.
that could lead to people using reputational risk
Yeah.
in an inappropriate way.
Mm-hmm.
And what it's really grounded in is having a reasonable and apolitical risk assessment.
Yep. Mm-hmm.
And so I don't know if any rules occur to you, Elizabeth. I was trying to think back. There's really no obvious rules or regulations where this is directly impacted. So I'm not sure what the agencies are going to end up doing there.
I know when I'm thinking about the different sections of the examination manuals, and obviously OCC, Fed, and FDIC are structured a little differently, but when I'm thinking about their examination manuals, there's no like obvious section. They never had a section of a manual that said we're examining for reputation risk. Obviously, it was referenced, the OCC going through and literally doing a control find function. It was in there. It was in their manual for sure.
Oh, yeah.
But there's not a regulation, blah, 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 that says reputation risk. There's some regulation B considerations, potentially, maybe Equal Credit Opportunity Act.
Yeah. Yeah, that's fair. And so then the last thing the order says is that the agencies have to order institutions they have to conduct a review of institutions to see if they had policies
Yep.
and practices that
Mhm.
resulted in, I'll call it unlawful debanking activity.
So that's
And
the
then-
immediate impact to banks. Immediate.
Yeah, and that's sort of whiplash too,
Yep.
Elizabeth, right? Because they've been told that if you bank certain industries,
Mm-hmm.
it's disfavored, you're going to be scrutinized.
Yep.
And now the same regulators, mind you,
Yep.
are going to give them a hard time potentially because
Yep.
of doing that.
Yeah. Literally some of the same field examiners, same ones who have been inside the same banks, are operating on different guidance from a different White House.
Yeah. So that's going to result in some very interesting conversations, both within the banks, within the regulators, and probably in an exam setting.
Yeah.
As well. And so, and if there's religious discrimination, the executive order says
Mm-hmm.
you got to refer that to the Department of Justice
Sure.
if the agency finds it.
Mm-hmm.
And then the SBA is involved in this as well
Yep.
with the executive order.
Yep.
I'm sure a lot of community banks have received
Yep.
the correspondence from
Yep.
the general counsel of the SBA
Yep.
saying you've got to do a review to see if you
Yep.
turned away any borrowers
Yep.
on the basis of these inappropriate, unlawful, discriminatory reasons.
I've
And
heard
you
from
have
bankers
until
reaching out and saying we would never have turned away a borrower on that. We have objective, denial standards, and some bankers were quite confused and felt that there were maybe pointing fingers at practices that they would have not dreamed of undertaking. I understand that they do need to conduct that review, but some of them were puzzled how to even review. It's
a very fair question.
Yep.
And the underlying premise is a little odd. I mean, banks want deposits.
Yes.
They want to loan money. So they're not going out of their way to turn away customers.
They want customers. Yes.
100%. And they're also not stupid. So we can, as the banking community, think about reputational risk ourselves.
Mm-hmm.
We don't need the regulator looking over our shoulder with their view of reputational risk and imposing it on us, in my view. And I think you're right, though, that it leaves lenders and banks in an odd position now about what are we supposed to do in response to this.
Do you have any thoughts or guidance
or
wisdom?
There's a few things, right? So I think even if it's sort of a self-serving statement, I think folks should look at their policies and insert a line that says we're not going to turn away business
Yeah.
based upon political or religious belief.
Yeah. And now it's your policy.
Right.
Yeah.
And then you can, in your board minutes, have the policy approved. And so there's the board is supportive of the policy. So you have a couple things you can show an examiner when they come in. As far as the look back goes, that's interesting because I agree that there's not going to be any instances, I suspect, very few, where a bank is going to say, yes, we did turn away business based on one of these bases.
Yeah, I'm curious if there are self-reporting forms coming in saying, yes, we found evidence.
I would be very surprised, if I was joking with a colleague the other day where, like, for the SBA, whoever's manning that inbox, they're going to arrive every morning, ready to get some hot leads for an investigation. And all these forms are going to say, no, we didn't have a policy and we didn't do any unlawful activity. So it's going to create a bunch of activity, I think, on the part of the banks, but probably not. It's kind of performative politically, I think, in my view. And it's a way to show, a certain segment of the conservative community that, yes, we hear you. We're taking action against this. But I don't think it's going to have I don't think they're going to find a lot, is what I would say.
I'm interested in the emphasis on religious discrimination because banks are not permitted to discriminate on lending terms on religion anyway. So there's already been some protections for folks in terms of religious beliefs. And like you're saying, I would be surprised if banks were going to self-report in large numbers that they were turning away like deposit accounts based on religious beliefs. Now, I understand there was that case with that organization that felt perhaps there were religious concerns, even though the bank perhaps felt that it was other concerns based on their transactional activity, maybe.
I think that's right. But I do know this is going to be a top of examinations. The marching orders from the top down are you're supposed to examine banks for this sort of thing.
Yes.
And so I do think it's important for banks to have a game plan before the exam about how they're going to handle these questions and put a process in place to do some review that's appropriate for their size. That could just be the leadership team talking about it and reviewing some loan committee minutes.
I do think it could be an issue for banks that maybe have not had a strong procedures for documenting their denials, especially when it comes to business applicants. There's not always a lot of regulation that says how denials have to be documented. So if it's been kind of just post-it note in this file or a verbal confirmation with that manager, I'm not trying to say all banks are operating that way, but you do find sometimes that that's what's in the files. If there's not strong documentation, it could be hard to prove that the bank did not engage in this activity, even if they don't believe they did.
Yeah, I agree with that. The documentation is going to be huge. If it's, I guess there's two ways to look at it. One is the customer who was declined. This is almost always going to be lending.
Yep.
Are they sort of do they fit the profile of somebody who could complain about religious or political discrimination? And if that's the case, then absolutely you better have a really buttoned up, well-documented reason based on your objective criteria of why you turned away that business. Second, and sort of related, is complaints.
Yes.
So there's a bit of a roadmap now on what language to use to complain about this to a regulator if you are a borrower who is rejected. And so to get ahead of it, you want to have that documentation in place to protect yourself.
I heard from a bank, just anecdotally, that their complaints program was looked into extremely carefully at a recent exam. I think this was an FDIC exam, and that's common. That's not unheard of. But it could be that complaints programs will just be scrutinized very, very carefully.
Yeah, I think that's right.
Mhm.
I think that's right. And so, it is interesting to me when I think about this a bit where one person's opportunity is another person's reputational risk,
Yes.
perhaps.
Hmm.
And there's still an opportunity, as I read it, even in the executive order, the door's not completely shut to a bank
Hmm.
using reputational risk.
That is interesting. I was going to ask you about that, so I would love to hear your thoughts on
It's
that.
almost there. It's
Hmm.
almost there, but
Hmm.
there's some opportunity. I think you have to have a really good
Hmm.
explanation
Yep.
for it, and the
Hmm.
you know the over the top
Hmm.
hypothetical I'll give is there's some
Yep.
the local Ku Klux Klan chapter wants to open an account
Yep.
at your bank.
Yep.
Now they have horrendous, horrific beliefs,
Yep.
but do I really have to take that business? And what if the community learns that
Hmm.
I'm allowing them to bank with me?
Hmm.
Community's probably not going to be happy. In
Yep.
most places, I would hope
Yep.
that that's happening. And
Yep.
so, can you connect the dots? Would that be sufficient for a regulator where they
Hmm.
say, okay, we
Yep.
understand
Yeah.
here, this makes sense.
Yeah. If a bank says we just simply are not willing to be connected to an organization such as the Klan, is that
Yeah.
going to be acceptable? I would hope so.
Yeah. I mean, they didn't have that in mind when they talk about like First Amendment protected activity.
Exactly.
But, you
Exactly.
know,
Yep.
I think I would hope there's some discretion there. Um, but it should be an apolitical
Hmm.
risk-based assessment is the
Yes.
phraseology that's
Yep.
used if you're
Yep.
gonna do it.
Yeah.
So as an advisor, I'm curious where you think that leaves you when you're advising banks.
Mhm.
Are
We've
you
been
going to
giving some
reference
of the
reputational
same.
risk anymore?
We've been giving some of the same guidance you mentioned, so I'm very happy to hear that someone like you is probably on the same page as people like us. But we have been sharing that it would be a very good idea to get this into your policy and procedures, board approval, and make sure that your loan staff truly understands what this means when it comes to actually assessing applications. Perhaps that doesn't mean anything will actually change with the bank's underwriting and approval standards because perhaps there never was actually at an individual bank, maybe there wasn't ever actually any emphasis or actual debanking activity going on, but make sure that your staff actually understand what this means so that when you are reviewing applications, but also talking to examiners, you're able to articulate that. Um, in terms of changing a bank's actual underwriting and credit approval standards, if they seem to be based on objective criteria, so often what we're hearing from banks is banks want customers. They don't want to turn anyone away unless there's a serious problem. And so often that's going to be based on, cash flow for a loan, repayment ability, which is
Yeah.
objective standards that banks are still permitted to use. In terms of those, kind of fuzzy areas, like we really, really just don't want to work with a customer like this or like that. You brought up the example of, a terrible organization like the Klan. I have not heard from any banks that are concerned that they have an application from, a customer that they're just horrified to think about working with. I haven't heard from anyone yet facing that down. Maybe they will. I don't know. So
Yeah. The other thing I would add to that too is there probably will be occasions where it's appropriate to escalate to senior management within the bank
I love that. Yep.
before business is declined.
I love
And
that.
part of that's going to
Mm-hmm.
be just to make sure we've documented this
Mm-hmm.
and thought about this the right way, and we're not applying sort of these subjective
Yes.
reactions to it,
Yep.
but this is truly,
Yep.
doesn't fit our lending policy for whatever
Yep.
reason, for example.
And honestly, some of this would come back to general UDAP guidance that we've been giving for a long time as well. Treat similarly situated customers in a similar way. Some of that is applicable to this concept of debanking as well. That you need to have objective standards and treat customers in similar objective ways.
Yes,
Um,
yes, that's very well said.
so,
I think reputational risk is still going to be important,
mhm,
maybe not as much when we're talking about taking on customers or turning away customers,
mhm,
but the actual bank's activities,
mhm.
product mix,
Yes.
vendor relationships, third
Mhm.
party relationships, I think there's still opportunities for advisors to point out these considerations.
Mhm.
I think it's important for
Yeah.
management to still think about it. So, if you have a product that's directed towards veterans or the military community
Mhm. Yeah.
or the elderly, it's typically as a non-bank product, like a reverse mortgage.
Yep.
Reputational risk is a real
Mhm.
thing there.
Yes. Yep.
You don't want to
Yep.
be known as the
Mhm. Yep.
predatory lender, predatory
Yes.
provider for those. So
Yep.
that's perfectly legitimate
Mhm.
to consider reputational risk.
Mhm.
It's where I see the regulatory scrutiny
Mhm.
is when we're turning away
Mhm.
customers or business
Mhm.
opportunities, which, as we've said, banks are not
Yep.
inclined to do anyway.
Yep.
So for that reason, I
Mhm.
think it's a little bit of a,
Mhm.
um, I won't say tempest in a teapot, but
Yeah.
there's some political window dressing going on here
Yep.
for sure.
Yeah. I appreciate that you mentioned that banks can consider reputation risk if it comes to something like how a bank is handling like service member requests, stuff like that. Those are aspects of community engagement where folks in the community might really respect or be displeased with how a bank is handling a certain segment of population. Certainly, it's very, very popular to protect our service members, for example. So banks are certainly allowed to still consider reputation risk when crafting products and services. They just need to be mindful of the debanking concept now. Is that fair to say?
Exactly. And
Okay.
then, if you're going to use a service provider that's going to be directly interacting with your customers, for
Yep.
example,
Yep.
you're supposed to be doing the due diligence with them anyway,
Yes.
right? But you could,
Mm-hmm.
if you get into business with somebody who's
Yep.
has a poor reputation for
Yep.
compliance,
Yep.
following
Yep.
your directions, customer care,
Yep.
please think about that.
Yes.
You're encouraged to, at least from my perspective.
Because customers are still going to have an opinion of a bank. They're either going to trust their local community bank or, a big bank nationally, or they're not going to. And that essentially is reputation risk. It could have nothing to do with political debanking. It's about how people
Yes,
view the business and whether they trust them to put their money there.
that's right. Yeah, and social media, there's we could spend a whole podcast on that, but people get really riled up
Yeah,
on social media.
they do.
You recall Cracker Barrel,
Yeah. Yes.
boring traditional Cracker Barrel
Mhm.
was the subject of a firestorm for, I don't know if it was a week or how long it was,
Yeah.
but
Yeah.
they wanted to get rid of the knickknacks and change their logo,
Mm-hmm.
and people lost their minds
They did.
on Twitter. People were weighing in that you would be shocked or even paying attention to it. And so they quickly backtracked, but it was
Yeah.
not a good experience for them from a PR perspective, for sure.
So banks are still allowed to keep their marketing teams, their PR teams. I mean, this concept of reputation risk is, as you said, it's a little bit of a political thing, and it is maybe a little bit more procedural than might have actual impact on some banks. Is kind of a stance I'm finding with some banks. Um,
Yeah,
but in terms of marketing, image, PR, all that, banks are still businesses. They still get to market themselves and handle their PR. Is that fair to say?
that's exactly right.
Yeah.
And businesses are thinking about this sort of thing
Mm-hmm.
all the time.
Of course they are. Yeah.
Banks should be
Yep.
no different than that.
Yep. I think I think that's a helpful point. I am so appreciative of how you laid out not only the timeline but then the considerations that banks need to be thinking about with this right now. This has been such a clear presentation, and for me such a fun conversation to have because I'm a compliance professional who deals with this. So I think our listeners are really going to appreciate that as well. Do you have any final wrap-up statements, advice you would give to bankers, final thoughts, anything to end up the conversation for us?
Yeah, so thank you. And it's been a great experience. So thanks for having me on. What I would say is huddle up with your team,
Mm-hmm.
talk about this issue,
Mm-hmm.
how you're going to be buttoned up
Mm-hmm.
by exam time
Yep.
on it. Or you
Yep.
may receive like the SBA is sending this, that's a pending, I
Yep.
think it's January 5th, I want to say.
That
is
sounds
when
right to
those
me.
responses are due, something like
Yeah.
that. So talk about it. How are we going to do sort of a good faith inquiry as an organization into whether we've debanked? So that could be talking to your loan officers. That could be in conjunction with your leadership team having a conversation about it. It could be going through your loan committee minutes. Sometimes I wince at those anyway. Sometimes they're not phrased great with the loan committee minutes. So just general reminder to folks, be cognizant of how you're documenting your loan committee decisions. But those are sort of the three, and complaints, right? But if you sort of hit those four areas to do your due diligence on what could be the scope of your debanking, hopefully it's none. I expect it's going to be none in 98, 99 plus percent of the time. Then you can respond when the regulator is going to ask you about it. Hopefully you will also tell them we've updated our policy. So that could be our lending policy. Maybe there's another appropriate policy to do it, to affirmatively say, we're not going to turn away an otherwise qualified customer based on political beliefs, religious beliefs, or lawful business activity. You got to think about that last one maybe, because there, again, the door is a little bit ajar still for reputational risk. So, you know, I just say, think about that one. But if you do those things, I think you're going to be in good shape.
I love that recap. I think that'll give some bankers some peace of mind, because I am hearing from bankers who are stressed out about this, concerned. And with that recap, just helping bankers understand that it's about reviewing, documenting, and basically providing resources to examiners to show that you've looked into it, potentially, maybe likely you haven't found anything, and here's how you're going to move forward.
Yeah.
Well, Kyle, thank you so much for joining us. I appreciate this so much. I had a really good time talking with you about this, and I appreciate the guidance you've given us, sharing your thoughts and your perspective on this. Thank you so much. Folks, this has been another episode of Banking Matters. I'm your host, Elizabeth Holtrop, and we hope you'll tune in next time.